Well, as you finish your lunch, let me welcome you officially to our economic forum today. One of our guiding principles says that we want to create value for our customers and for the communities in which we operate. And as we thought about it, we publish monthly reports on the economy in Utah, Idaho, and Wyoming. We do special snapshots like the one you have on your desk or at your seat. This is on the U.S. economy, but we do them on various industries and other topics. But we thought, we should do an economic summit and have Robert present to you his thoughts on what's happening. So we're going to be doing that every 6 months. So this is the first one for this year. We'll be planning the second one in July of this year, and these are for the Greater Salt Lake market, and then we'll be doing some of these down south and up north so that his information can benefit everyone in the community, and hopefully that will help us to make good decisions on what we can do individually and as businesses in helping our economy to continue to be robust and helping our communities move forward. I think this is an interesting period of time because I can't remember a time when things have been going, relatively speaking, so well, and yet at the same time we've had so many challenges. And so Robert's going to give us the answers on why we're doing that and what we can do to overcome the challenges and make the most of the benefits we have. So this is Robert Spendlove. You know him as our senior economic advisor for the bank and as a member of the U.S. or of the state of Utah House of Representatives. So, Robert.
Thanks, Scott. It's great to have everyone here today. In addition, what we're going to be doing, we're kind of testing out this format. We're going to be filming this as well, and after this event is over, we'll be sending out copies of the video to our mailing list, and we'll have a special website set up for this event. So if you'd like copies of my presentation, of the special snapshot, or if you'd like to review the video, we'll have that available. In addition, on each of your tables, there's a sign-up sheet. If you're not already on our economic email distribution list, just fill that out and we'll include you. And then also, if you'd prefer, you can also go onto our website, which is zionsbank.com/economy, and just put in your information, and you'll be included on our email distribution list. So one other thing, and we're trying this out, we're going to see how well this works. As we're going, if you'd like to tweet out any information or insight, just on Twitter, put in the hashtag Zions Bank Outlook 2020. And by the way, we're also going to have, just because of the format of the filming, we're going to do questions via 4x6 note cards, and every table has the note cards. So if you have any questions, fill out one of the note cards and we'll answer those at the end. Or you can also, on Twitter, if you put in the hashtag Zions Bank Outlook 2020, we'll be reading questions from Twitter as well. So what I want to do, it's been a really interesting year in 2019, and going into 2020, the economy is looking good, but there's also a lot of different indicators that are providing some mixed signals, honestly. And so it's helpful to kind of look into those and say, okay, what are they showing, and what do we think that indicates for our future economic growth? So looking back at the last year, what were we seeing? So just think back a year ago. Remember, heading into 2019, in December of 2018, the Fed had risen interest rates 4 times in 2018. And then in December, in their 4th rate increase, they said, we will raise rates again 3 times in 2019. And so equity markets did not react well to that announcement. If you remember the Christmas Eve stock market crash that we saw in 2018. We also started seeing something that we haven't seen in a long time, which is inversion of the yield curve. By the way, I'm going to get into each one of these and kind of talk through them, so, but just wanted to give a little bit of a preview. We were also, this time last year, in the middle of a federal government shutdown, which was creating a lot of uncertainty. We started to see uncertainty related to the trade war with China, the USMCA with Mexico and Canada. And then we saw signs of inflation rising above the preferred level that the Fed and economists like to see. So that's kind of a preview of a year ago. What are we seeing now? So let's first look at equity markets. Interestingly today, I don't know if we're still there, I haven't checked in the last few minutes, but the Dow Jones Industrial Average this morning passed 29,000 for the first time ever. I pretty quickly dropped back down again, but we're in that range, 29,000, and you can really see, so if you kind of look right at the end of 2018, you can see the big drop in equity markets as a result of uncertainty from the overall economy. But since then, we've seen a big increase. 2019 has been a very strong year for markets. The Dow Jones Industrial Average went up 23% last year. S&P went up 29%, and the NASDAQ increased 35% in 2019. So markets have come back very strongly. Now, markets are what we call a soft indicator. There's kind of hard data and there's soft data. And markets are based on expectations of future economic activity. So they expect markets in 2019 saw that the economy was improving. So why did they see that? What were they looking at that made them have more confidence throughout 2019 and going into 2020? So first let's talk about the jobs market. I'll tell you, this is one of my favorite things about my job is the data changes every single day. So I had to update this presentation I was literally working on it until about half an hour ago. And here's the reason. We got a slew of new data at 6:30 this morning. The first Friday of every month, the Bureau of Labor Statistics releases its monthly jobs report. And the jobs report is, in my opinion, the most important economic report that's released by the government. The reason they release it at 6:30, so 6:30 our time, 8:30 Washington time, they do that because it's before the markets open. And it's such an important indicator. It's what we call a market mover. If they embargo it, so no one gets to see it outside of a very select group of people, and then they release it. If you're ever really bored, turn on CNBC at 6:30 the first Friday of the month, or turn it on at 6 o'clock, because they play the song Final Countdown. You know, it's like you're getting ready for the big game, but it's the jobs report, so it's kind of like, you know, football game for nerds. So it came out, and what did we see? So, and I'll try to point out which slides are as of this morning, and that's the one downside, is your snapshots are from, they're almost current, but I couldn't update them this morning. But so that there's a little bit of a difference between the snapshots and the presentation. So what do we see? We are now in the longest economic expansion in our nation's history. July of last year, we passed the previous record set in the 1990s. We're now at 127 months of consecutive job growth. So we've seen, it's really the entire decade, the entire last decade, we have not had a single month of job losses. That is phenomenal growth for our country. When we look at, this is showing job growth by month in our country. And you can really see, just to kind of show you, that blue part that's dropping is the Great Recession. And at the peak of the Great Recession, we were losing 700,000 jobs a month for 6 months. So you can see how dramatic and difficult that period was because of those job losses. And then coming out of the recession, so you can see how long that growth has been. of that consecutive job growth. However, there's another area to kind of look at this, which is even though this is the longest economic expansion in our nation's history, the degree of the expansion has been much lower than past expansion. So it's been long, but it's been relatively weak compared to past expansions. And generally what you would expect to see is with a very deep trough, you would expect to see a very similar peak coming out. And we started to see that. You see how we jumped 500,000 jobs, but then it just kind of lost steam. And we've been on cruise control ever since then, growing about 200,000 jobs a month. And you would expect to see a big jump coming out, and we just never saw that. So there has been a lot of pent-up demand in our labor market, but I believe that's part of the reason why we've seen such a long economic recovery. When we look at kind of zooming in a little bit more, this is pulling in the data from this morning. So the expectation for the jobs report this morning was that we would see about 160,000 jobs created in the U.S. economy. We came in a little bit below that. We came in at 145,000. Now we're still growing, but it's a little bit slower than we were expecting. I think that's still within kind of a decent range of what we would expect to see given the current economy. However, so this kind of closes out 2019. And 2019 now officially is the third lowest job growth in the decade. And so we are seeing some signs of that downward pressure. There's no doubt that we are in the late stages of our economic cycle. Now the question is, are we at the very late stages or just the later stages? And that's what I'll talk about a little bit more in just a minute. When we look at where the jobs are growing, this is another sign of the breadth of our expansion. We are seeing some contraction in, and again, this is national, we're seeing some contraction in the natural resources and mining area, but then big growth in construction. Look at that, 2%. Look at education and healthcare. So the BLS, the federal government lumps them together, but that's really, most of the growth you're seeing in that education and healthcare is really in the healthcare sector. So very strong growth in the healthcare sector, and then also in our construction sector. But our manufacturing sector has been experiencing some weakness, and we're starting to see some downward pressure in that area. When we look at the number of jobs created, you see even more prominently education and healthcare led the way with the absolute number of jobs, but we also saw good growth in leisure and hospitality and also in professional business services. Now, if you think about, if you kind of divide up this graph, the top is goods producing, the bottom is service producing. And you can see that most of the growth in our economy is coming from the service producing sector. Now, while manufacturing is still growing about 46,000 over the last year, we have seen a lot of signs of weakness. So the jobs report that came in this morning said that over the last month, manufacturing actually contracted by 12,000 jobs. And if you compare that 46,000 growth this year to last year, it's about 10% of what we saw in recent history. So we are seeing a lot of slowdown in the manufacturing sector. Now, why is that? And this is one of our big themes that we're seeing, is it's uncertainty tied to international relations, specifically the impact of the trade war. So what this is showing is it's what we call a 12-month rolling average. So it's the change in jobs compared to 6 months ago. And so what you can see is that we had accelerating growth coming out of the 2016 election into 2017 and 2018. The expectation of future economic growth was high, and employers were hiring a lot of people. But then you see right here in the middle, that's where the U.S. implemented the first Chinese tariffs, and it had a direct impact on our manufacturing sector. And so you can see that ever since then, the growth in manufacturing on a year-over basis has been shrinking, and now we're down at just about 46,000 jobs over the last year. So it has had an impact. And it is, the reason is it's just creating a greater level of uncertainty in the business sector. Now, moving forward, looking at unemployment. Unemployment is a really interesting one. It's kind of a double-edged sword. So again, this month, we are at the 50-year low in our unemployment rate. The last time we saw unemployment at 3.5% was December of 1969. So it is generations old low in our unemployment rate. And if you think about it, what was happening in December of 1969? Vietnam. So I would argue, because during Vietnam, you have a lot of people that are taken out of the labor force and are put into the war effort. And so you could argue that our unemployment rate today is effectively lower than it was in 1969. So it is an extremely unique and low and tight labor market right now. But the other thing I want you to look at, so those vertical lines that you see throughout the graph are recessions. And so, and you can see that they occur kind of in a variety of time periods, a variety of lengths. But there is one thing that you'll notice with this unemployment rate. There is a tie between the unemployment rate going from a low and turning up to the start of recessions. So what we know is that there is a relationship between unemployment going up and recessions. And what do we know right now? We know that we're at a 50-year low. What we don't know is whether the unemployment rate will continue to go lower. It certainly could. And we also don't know when it will start going up. But if we start to see signs, if we see a jump from 3.5% to 4% or 4.5%, that could be an early indicator that a recession is on the way. But the good thing is we're not seeing that right now, and we're not forecasting to see that. The unemployment rate stuck at 3.5%. In November it was 3.5%, and December it stayed at 3.5%. But that's something I'll be watching really closely. When we look at kind of a broader measure of unemployment, and this is a really good sign. So this is looking at unemployment for Hispanic or Latino, and also for African American. And we see that both of those measures of unemployment are at all-time highs. So what we're seeing is that the benefits that we're feeling in the economy are being felt widely throughout a variety of different groups. Another measure that we look at, this is what we call underemployment. The technical definition with the Bureau of Labor Statistics is U6 unemployment. And so the bottom one, the blue one, is the traditional unemployment rate. The top one is the underemployment rate. With underemployment, what we do is we bring in marginal workers. We bring in people who are working part-time for economic reasons, or people that are discouraged workers, essentially working the wrong type of job. And that gives us kind of a broader measure. Again, what we're seeing with our underemployment rate is that it is at one of the lowest points that we've ever seen it, and it's the lowest point since the 2000s started. Also, the gap between the unemployment rate and the underemployment rate has narrowed dramatically from 7.1% coming out of the Great Recession down to 3.2%. So again, it's another indicator that our economy is operating very efficiently and is doing a much better job of connecting people, connecting labor to employment in an efficient way, and bringing together those resources much more effectively. So another really good sign of the strength of the economy right now. Labor force participation. This is the broadest measure of employment. Essentially what you're looking at when you're looking at labor force participation, if you take the entire population, the entire working age population of the country or of an area, so 16 to 116 years old, how many of those people are working or looking for a job? That's your labor force participation rate. And you may say, well, you can't work if you're 116 years old. I will guarantee you that there is a 116-year-old right now that is working somewhere in our country. And it's that person who says, I'm going to work till I die, and they really do. And so even if you may be above the traditional working age, you still can work. And according to the Bureau of Labor Statistics, you are part of that potential labor force. So that's how we get that number. And what do we see? Again, this is another one of the numbers from this morning. The labor force participation rate held steady. So it's at right around 63%. And it's a good number. This represents almost the highest point we've seen since 2013. So we're seeing a lot of growth. Hey, Drew, we'll just grab those. Yeah, Drew, if you want to just grab those. Sorry, let me just reiterate.
I just held it up.
Oh, okay.
Question, with the labor participation rate, what's the percentage collecting Social Security? What's the overlap, and has that overlap kind of...
Yeah, so the question was, what about the impact of the retirement community? And that's a great point. In fact, that's my next slide. So, looking good, and thank you, that was my plant. So we're looking good in kind of the short term, right? But now let's look at the long term. So this is going back to 1956. And you see that 50 years ago, our labor force participation was right around 59%. Then it jumped all the way up to 67%. Any guess why that's happening? Women in the labor force, exactly. We had an infusion of women in the labor force, which fundamentally changed our economy. It increased our productivity. It increased, in fact, for the first time this morning, we now have more women in the labor force than men. There you go. 107,000? 109,000 more women in the labor force now than men. It really has had a huge positive impact on our economy, on our labor force. That's how we peaked out in March 2000 at 67.3. Now, then you may say, okay, well, if it's dropping, that means women are leaving the labor force, right? No, that's not what's happening. It's the dynamic you're talking about, sir. It's a different dynamic. So this dynamic is being caused by retirement of the baby boomers. So to put that in perspective, every single day in America, 10,000 baby boomers retire. And that will continue for the next 10 years. So you can just think of that. They call it the silver tsunami. The silver tsunami washing over our country and pulling them out to their cruise ships. But it has a huge impact on our overall labor force. And this kind of ties in some of our public policy and some of our worker retention policies. We have got to do a better job, employers have got to do a better job of adjusting to the needs of the new workforce. Those retirees, a lot of them want to work, but they don't want to work 5 days a week, 40 hours a week. They want to maybe have flex schedules or consulting or different types of labor agreements with their employers. And if we wanted, the big debate in economics right now is, can we get back to where we were in 2000? And I would argue it's possible, but we've got to start rethinking the idea of what labor looks like in our country. Now, the other result, of course, is looking at, so this is a ratio of workers, unemployed workers per job opening. So essentially what you're looking at is, coming out of the Great Recession, we had 6 job applicants for every job opening in our country. Where are we today? Less than 1. There is less than 1 available person for every open job in the country. So this is what we talk about when we talk about this huge labor shortage. It's becoming more and more difficult to find people to fill these jobs. And the problem is, employers don't just want warm bodies. They want people with the skills and the knowledge and the ability to do these jobs. And so we've got to be focusing even more on alignment between the needs of employers and the abilities of workers, and making those connections even more directly. Now, zooming in, if you think it's bad at the national level, wait till you see the Utah level. So the nation is the dotted line. Where's Utah? Utah's right there, right at the bottom. In Utah, it is 0.56. What does that mean? It means for every unemployed person, there are 2 job openings in the state of Utah. Great for the person looking for a job, really tough for employers trying to find that labor. And one of the struggles, remember how I showed you that relationship between unemployment and recessions. The more the labor market tightens, the more difficult it gets for companies to find that labor, the more difficult it is for the overall economy to grow. Think if you're in a very competitive industry and you've got to grow to survive. If you can't find that labor, then you can't grow, and it can actually start to cause serious problems in the overall economy, or definitely constrain potential economic growth without that access to labor. So I'm going to jump back. Okay, so we've just established a relationship, right? There's a law in economics. We call it the Phillips curve. And that law says when you've got, just think back if you took, Econ 101, supply and demand, right? So what we've just established is there is a very low supply of labor in our market, and there's a high demand for labor in that market. Okay, quick pop quiz. When there's low supply and high demand, what happens to prices? They go up, exactly. So when you turn that into the macroeconomy, that those prices paid are in the form of wages. So wages should spike. And if wages go up, employers just can't, they can't just pay more for labor. What do they have to do? They have to raise their prices. And when they raise their prices, it causes inflation to go up. And so when you see this tight labor market, you'll see wages going up and you'll see inflation going up, right? Wrong. So that's the problem. Janet Yellen has called this the biggest mystery in economics right now. This month, or this morning, we just got the new wage growth number for the last year. Last month it was 3%. Today it's 2.9%. Why in the world would we see wage growth softening in such a tight labor market? And it was really interesting. So again, think back a year ago. The Federal Reserve is right here, and they're watching this tightening labor market. And they're saying, okay, well, the Phillips curve says in a tight labor market, wages spike and inflation spikes. So the Fed is looking at the prospect of a big spike in wages. That's why they were getting aggressive in increasing interest rates and committing to more interest rates. And then something happened, and the system broke. So this point at the very top is the February jobs report of last year. So 11 months ago. We hit a high of 3.4%. But then for some reason, that relationship that has existed forever has all of a sudden stopped working. And so now everyone's kind of scratching their heads and saying, what's going on? Why is this happening? And honestly, we don't know for sure. We're not exactly sure what's going on. There's several theories. One of the theories is artificial intelligence and mechanization. That employers are able, because we're going through a technological revolution, it's easier to replace that labor than we could in the past. Think about going to McDonald's. You can just order from a kiosk now. You don't have to order from a person. Think about how you order online. A lot of that is driven by artificial intelligence. Things like self-driving cars are revolutionizing our labor force. So that could be one dynamic. Another dynamic, if you think about Thomas Friedman wrote the book, The World is Flat. We have a much flatter world today, and so producers are able to move their resources much more easily. If the production becomes too expensive in America, what do? You move it to Taiwan. When it gets too expensive in Taiwan, you go to China. When it gets too expensive in China, you go to Vietnam. So there's so many choices, so they're able to defray some of that pressure to increase wages by changing production. But again, we're not exactly sure why, but we do know that it's happening. Now, let's look at inflation. Oh, sorry. Another interesting dynamic is breaking it up by essentially high wage earners and lower wage earners. So this is looking at supervisory employees and non-supervisory employees. The supervisory are blue, the non-supervisory are green. And we actually saw there started to be an explanation because we saw a divergence. Surprisingly, what we saw is the non-supervisory wage earners, we're seeing much higher wage growth than supervisory. Now, an explanation for that could be the increase in minimum wages in many states and many cities. And so that would drive up the non-supervisory wages. But again, as soon as we start to develop a theory, all of a sudden it comes crashing down. This month, as of this morning, the two have diverged. So now we're back to supervisory and non-supervisory are growing at the same rate again.
Your label doesn't call that supervisory on the purple. Average overall wage growth.
Yes, yeah, I just pulled out the non-supervisory out of that overall. Yeah, thank you for pointing that out. But it just shows that how every time we start to develop a theory, all of a sudden something happens and it kind of blows it out of the water. Now let's look at inflation. Again, so if we were to cut this off right here, the Fed's looking at the situation. We see inflation accelerating, getting higher and higher, approaching levels that we haven't seen since before, heading into the last recession. And then what happened? All of a sudden, about the same time, inflation starts dropping off. So the Fed has what they call a dual mandate. The Fed is mandated by Congress to focus on two things: full employment and low and stable inflation. And the Fed has specifically targeted their inflation target at 2%. So that's why we have a green line right at 2%. And so generally speaking, if inflation is above 2%, the Fed will raise interest rates. If inflation is below 2%, the Fed will tend to lower interest rates. And so again, the Fed was looking at this and they said, okay, we have to raise interest rates. And then all of a sudden, the bottom drops out, and now we've got inflation below their target, which is why you've seen the Fed reverse course over the last year. Looking back even further, though, we've seen a major change in our economy. If you remember back in the 1970s and 1980s, we saw inflation topping 15%. Our new generation can't even imagine 15% inflation. In fact, in the last 10 years, we've seen two periods of deflation. You can see that in 2010, that was what really caused the pain in the Great Recession, was a deflationary period caused by the drop in housing prices. But then also again in 2015, we saw a period of deflation. So the downward pressure on our inflation is much greater today than it has been historically. One of our next major measures of overall economic health. Now this is the number one measure of the overall economy, is the gross domestic product. It's the value of all goods and services in the economy. And it's what we watch really closely. How is it looking? It's coming in okay, growing about 2.1%. Generically, the definition of a recession is if you have 2 consecutive quarters of negative GDP growth. And so we're not seeing that. We continue to see GDP coming along pretty well. However, it's a little bit slower than we were expecting. We were expecting closer to 3.3 to 4%, and we just haven't seen that. The expectation for 2020 is that it will continue to slow. Right now, the kind of consensus among economists is that we'll see GDP growth around 1.5 to 1.8%. So we'll continue to see that slowing trend as our economy moves through its cycle. And a big part of that is just that potential. How are we? It's back to that struggle of labor. If we can't get more labor, we can't grow. And if we can't grow the labor force, then we're going to see it having an impact on our overall economic growth. And so unless we have some kind of a breakthrough or a major change, we see that lack of labor and that very low unemployment will continue to grow the overall economy. But now what I want to do is I want to dig in a little bit into this GDP. Again, let's go back to your Econ 101. GDP is C plus I plus G plus net X, right? Consumption, so consumers, plus I, investment, that's business, plus G is government, plus net exports. That's what drives the economy. Those are the major parts. So when we look at what's happening and look really closely at this bar on the right, what you see is consumers are up, government is up. What's down? Businesses and exports are down. So that's a dynamic that we've seen throughout 2019, and we expect to continue to see into this year. So what I did here is I broke out the two biggest components, consumer spending and business investment. And you can see in the beginning of 2019, we had strong business investment and consumer spending was relatively low. However, in the second and third quarters, the most recent data of 2019, the consumer has been spending well, but we're actually already in a business spending contraction in our country. For the last 2 months, we've seen business investment contract in the GDP. So that's a tangible sign of some of that struggle that we're seeing. Now, overall, the consumer has always been about 2/3 of the economy. So consumer has always been the most important part of gross domestic product. So if the consumer continues to spend, and if the consumer continues to feel good about the economy, then we'll be okay. But if this weakness in the business sector starts to flow over into the consumer sector, then that could turn into much more weakness in the overall economy. How would we see that? We go back to that jobs report. You know, if businesses get so nervous, right now they're just kind of holding back on their spending. But if they go the next step and say, you know what, we're going to hold off on our hiring now too, that's where it translates into a real struggle in the economy. But right now, at least for right now, the consumer's still good and is holding up the overall GDP. Why is that? Consumer confidence is also holding up. We saw a nice run up in 2016, 2017, and heading into 2018. And even though that uncertainty has increased last year, it hasn't caused a dramatic drop in consumer confidence. We're right around 126, 127. To put that in perspective, that green line at 110 indicates that consumers feel that the economy is prosperous. So consumers still feel really good overall about the health of the economy. And if consumers feel good, they'll continue to spend. And if they continue to spend, the economy will continue to grow. When we look at digging in a little bit more, why is the business sector weak though? So what I did was I split it out into two parts, the service sector and the manufacturing sector. This is the Institute of Supply Management Manufacturing Purchasing Managers Index, PMI Index. And the red line in there is kind of your critical line. If it comes in above 50, it means the economy or that sector is expanding. If it comes in below 50, it means they're contracting. So what we see again, very similar to what we saw in the jobs report, is we continue to see expansion in the service sector coming in at 55%. So relative strength in the service sector. But what do you think the manufacturing sector is going to look like? Contraction. The manufacturing sector has been contracting since the fall of last year. We just got this data this week, and it's continuing to drop, coming in at 47.2%. So that's really what's driving that weakness is manufacturing, and that the weakness in manufacturing is being driven by that ongoing uncertainty about international relations and about potential trade wars. And then we add into it the hostilities with Iran, and that just adds to that uncertainty. And when businesses feel uncertainty, what do? They just kind of hold back, and that's what we're seeing with the PMI index for manufacturing. When we look at the dollar's doing great. It's nearly at an all-time high. Now that's great if you're going on vacation to Europe, right? You know, a high dollar buys a lot of stuff. What if you're exporting things to Europe? Then you don't want a high dollar. And so that's what's driving our exports down. Our exports are more expensive because we have a high dollar. And so that's making it more difficult to move our products. When we look at oil prices, oil has been really interesting. There was, after the hostilities in Iran really escalated last week, there was an expectation that oil prices could spike, could even double. And surprisingly, we've actually seen a high level of stability in oil prices, and it's continuing. So we saw very high prices coming out of the last recession. But then right around 2014, oil prices essentially halved. In fact, we bottomed out right around $25 a barrel, from a high of $110 a barrel down to about $25 a barrel. And then it came back up, and it's been hovering right around that $40 to $60 a barrel range for the past several years. And I would expect that even with a shock or a potential shock that we saw this week, if that didn't cause oil prices to spike, then I think we're in a very stable range. And a big reason for that is the U.S. is now the largest producer of domestic oil in our country. And so we're seeing a lot of strength in our ability to resist some of the forces that we saw, say, in the 1970s. When we look at, now I want to get a little bit technical, a little bit geeky. How many of you have heard of the yield curve? Oh, good. Okay, good. So I'm still going to give it a little bit of description because I love the yield curve. The yield curve is essentially saying what is the return on investment of a bond at different time frames. So if you think about a bond, you have everything, and I've only got part of that yield curve. The yield curve can go everywhere from overnight to 30 years. And so if you're making an overnight loan, that's essentially loans that the Federal Reserve makes to banks to maintain liquidity. And then way out on your 30-year, that's your home loan. And so we have these different maturities. Now think about risk associated with buying a bond. The longer maturity you have, the higher your risk is. And if you have higher risk, you want a higher reward. So the yield curve should be upward sloping. So it should be low in the short term and higher in the long term. So we talk about an upward sloping yield curve. So let's look a year ago. What did the yield curve look like? So we see mostly upward sloping. But do you see this little thing right here? We started to see, this is called an inverted yield curve. So if there starts to be problems in the economy, if there starts to be changes in the expectation for future economic health, we start to see those yield curves becoming a little bit distorted. We saw an early sign of it in December of 18 and going into January of 2019. Fast forward to August, you can see how dramatic that inversion in the yield curve got. The real tipping point was right here on August 27th. The 2-year bond got higher than the 10-year bond. Historically, that has been one of the most accurate predictors that a recession is coming. And so when that 2-year went above the 10-year, that's when everyone really started to get nervous. That's when you started to hear all the discussion that the recession is on the way, we need to prepare for it. And so why does that happen? So if you think about it, the Federal Reserve, when we talk about the Federal Reserve with interest rates, we say that the Fed raised rates or dropped rates. The Fed really only controls one rate. They control what is called the federal funds rate. And that federal funds rate is on the far left. So the Fed controls the far left of the yield curve, but markets control everything else. So the Fed can raise and lower that Fed funds rate, and they can raise and lower short-term rates, but they can't do much on the longer term. So the Fed was keeping the Fed funds rate high, and the market said, we don't believe what the Fed is seeing, and they started driving the longer-term rates down, and that's what longer yields down, and that's what drove that yield curve negative. So how does it look today? We've largely fixed the problem. Now, why is that? Go back to that left side. The Fed got aggressive, and they dropped rates. The Fed moved that rate from about 2.5 down to 1.5%, and the markets feel better. And so that's one of the big themes of 2019 was the Fed's, and I have to give credit to the Fed. Most recessions are caused by mistakes by the Fed. The Fed won't adjust quickly enough, and we fall into a recession. And the Fed saw what was happening, and they got aggressive, and they reversed course on what they said was going to happen. You can really see that when we look at the federal funds rate. By the way, looking back, this is pre-recession. In 2006-07, we were above 5%. in the Fed funds rate. And then the Great Recession hits, and the Fed got aggressive, dropped the Fed funds rate essentially down to zero, and kept it there for several years. And part of that, if you go back to that long-term employment growth that I was showing you, we just didn't have the kind of strength to start moving off that zero. Around 2015, 2016, the Fed started to think that the economy was strong enough to start raising those rates again, and they rose those rates throughout 16, 17, and 18. The Fed rose interest rates, or rose the federal funds rate, 4 times in 2018. They said they were going to raise them 3 more times in 2019. What did they actually do? They cut them 3 times in 2019. Think of that, about that swing. This time last year, they were saying they were going to raise rates 3 times, and they actually cut them 3 times. That had an enormous impact on the economy and on markets. It essentially sent a shot of adrenaline into the economy and into the markets. Now, what is going to happen next year? So now I'm going to go even more geeky and nerdy. Have you ever heard of the Fed funds dot plot? I got you. No one has heard of it. Well, Paul, you've heard of it. Okay, yeah. Paul used to work for the Fed. So when the Federal Reserve Federal Open Market Committee meets, there's voting members. Each one of those voting members vote on what the interest rate should be now, and then they say, what do we think rates should be going forward? And then what they do is they provide a plot of what those rates will. Now, again, it's not saying what will happen. It's saying what they think will be appropriate in the future. But it's a great way to see what the Fed sees happening in the economy and where we think interest rates are going to go. So this, on the far right, it's hard to read, but that's 2019. Again, this was produced in December of 2019. So of course it's going to be the same. And it's right around that 2.5. What does the Fed think is going to happen in 2020? It's right the same. So the Fed is on a holding pattern. Jerome Powell said the same thing. They will not raise interest rates this year. They will not lower interest rates this year, all else being equal. Unless there's a major shock, or major change in the economy, the Fed is on hold for 2020. Now the good thing is, moving out a little bit further, they see signs or potential that we could see the economy improving. If the economy is improving, it would justify the Fed raising interest rates further off into the future. So overall, it looks like we may have dodged the bullet on the potential for a recession in the near term. This is not the first time this has happened. In the 1990s, we saw a very similar situation. About midway through the 1990s, there was a real threat of a recession coming, and the Fed reversed course there as well, and was able to stave off that recession for a few more years. And it's still a little early to know for sure, but the signs are that we may have pushed that off, and we're in a much better place. When we look at mortgage rates, again, we're back over. So we've just switched over from the far left side of that yield curve to the far right side of the yield curve. We're once again dropped below 4%. For mortgage rates in 2019. That's great if you're buying a home or looking for a new place to live. There are some struggles though in our overall housing market, and I want to talk about that just a little bit. The debt that we're experiencing, and this may be a little bit hard to read, we're approaching $10 trillion in housing debt in our country now, and over $4 trillion in non-housing debt. Now, in absolute terms, that may not make a lot of sense. So what I did was I wanted to break it down by sources, and this is where you really start to see the impacts. The one I want to point out is 2 things, the blue and the green. Since the end of the Great Recession, auto loans have increased 60%. Since the end of the Great Recession, student loans have increased 173%. Now that alone is scary, but listen to this. Right now, 1% of mortgage debt is delinquent. That's great, right? 5% of auto debt is delinquent. 11% of student loan debt is delinquent right now. If, not if, but when we have the next recession, that's where our weakness is. That's where I'm worried. Because again, remember how difficult it is. It is very difficult to dismiss student loan debt in bankruptcy. So people will be saddled with all this debt, and they're taking on more and more debt, and they're starting to slip higher into delinquency. That could be one of the triggers or one of the worst parts of the next downturn. And that's something that I'm very concerned about. Okay, kind of looking at this at Utah. We are in such a good place in our state. We continue to have one of the strongest, if not the very strongest economy in the nation. This is brand new data. We just got it last week from the Census Bureau. Utah is now once again the second fastest growing state in the country. We're actually in a three-way tie with Nevada, Arizona, and Utah. Idaho, once again, is the fastest growing state in the country. But you also see we're right in the middle of the fastest growing area of the country. There's several states in the east that are losing population. Illinois, West Virginia, Louisiana lost population. But we see increasing numbers of people moving to the south and to the west. And so we continue to be one of the fastest growing states in the country. Looking at the components of our change. So what's the makeup of our population growth? So number one, we topped 3.2 million people in the state as of last year. So really strong overall growth. But then if you look at it, the green part is what we call natural increase, so births minus deaths. The blue part is migration, net migration, people moving in minus people moving out. And we see that we have solid, we are coming down a little bit on our natural increase. In fact, for the first time ever, last year Utah dropped below replacement level in our fertility rate. No one ever thought it would happen. When I started my career 20 years ago, people liked to compare Utah's fertility rate with Bangladesh. And now we are actually lower than some other states. We no longer have the highest fertility rate in the country, and we are below replacement level. But this is also, if you kind of look, you'll see the little bumps. Those are our baby booms. And so we're coming off a baby boom at the same time that we have a lowering fertility rate. So that's why we see that overall natural increase coming down a little bit. But look at how strong the blue one is. That's a sign of net migration is driven by the strength of an economy relative to other economies in the region. So if our economy is good, more people want to move here. And we continue, because we have such a strong economy, we continue to be bringing in more and more people, topping 21,000. So our total population growth last year was about 50,000. So think of that. Every single year, we're adding a population the size of Taylorsville to our state. Every year. And so, again, it's good because it's feeding our overall economic growth, but it's also something that we need to be very serious about, looking at transportation and infrastructure needs of the state. Where is it growing? One of the recent trends, we kind of call this a donut effect, where you have slower growth in the urban core, but you have very high growth in areas on the periphery that have access to those urban amenities. So the recent trend is we're really seeing a boom in Tooele County, growing 3.7%, but then also Wasatch County growing 4%, and then our long-term trend of Washington and Iron counties seeing very high growth in the southwestern portion of the state. Moving to employment, as of last month, we're back to number one in the country in employment growth. Utah continues. We have been top 10 for years, and we're always kind of battling out with Idaho and Washington, and sometimes Texas jumps in there too. And once again, we're on top. So just to put in perspective, Utah's employment growth is twice as fast as the national average. Just phenomenal growth. And we are so far ahead that Utah's percent change is 0.5% higher than the next two closest states. Idaho and Texas tied for number 2, and Utah's is 50 basis points higher than theirs in the last month. Now that'll change next month, but it's just really interesting to see what's happening right now. Again, back to where the jobs are growing. Similar story, the big growth is in construction and also in healthcare. But we have all of our sectors are growing. Remember, at the national level, natural resources and mining was contracting, but in Utah, it continues to expand. And when you look at the absolute number of jobs, that's where healthcare actually emerges as our number one job creator in the state, followed by construction. Now, what about manufacturing? Remember how we were talking about how the manufacturing sector is struggling? Again, Utah is anomalous. We are defying, so Utah is in yellow. We continue to see growth in our manufacturing sector. It's actually one of our strong sectors. A lot of that is the manufacturing from other parts of the country is moving to Utah. And so Utah is really resisting a lot of those that weakness that we see at the national level. Where are the jobs growing? Similar trend. Again, you'll see Wasatch County really jumps out with 9.6% growth, but then also kind of throughout really the Wasatch back, again, southwestern portion of the state. But really, we're seeing pretty good growth through most parts of the state in employment. What about unemployment? Now, this one, frankly, shocked me. Utah generally has had unemployment, sometimes top 10, but it kind of hovers around 10 to 15th place. We're now second lowest in the country. Again, what that is showing is we are just tapping out our labor market. Our labor market just continues to get tighter and tighter. The only state with a lower unemployment rate than Utah right now is Vermont. Now, again, remember how I mentioned it's a double-edged sword. So we are really suffering from those labor shortages at the state level. When we looking at the unemployment rate relative to history, we are matching the lowest unemployment rate in our state's history. Last time we saw 2.4% was heading into the Great Recession. And what's interesting, and I'll be watching this really closely, that unemployment, you'll notice that low rate only stuck around for about a month or two before it started to go up and we went into the recession. I suspect, because our economy is so strong, that we may actually surpass or we may drop below that low unemployment rate from 2007, or we could hold steady at this very low rate. But we are in historic times in our labor market. Where are we seeing the different rates? Pretty much statewide, unemployment is very low. However, you do start to notice that urban-rural divide. One of the struggles that Utah is facing is bringing the benefits of the economy to the entire state. And right now, the majority of that benefit is being felt in urbanized areas along the Wasatch Front in Washington County or Cache County. And one of the things that we need to be working on is taking those, because we know we've got a labor shortage and we've got available labor in other parts of the state. And now we need to make that connection and take those jobs where they can do the most good. Another benefit though, and again, last year, Utah was top 10 in poverty rates, but it was at number 7. We've dropped from number 7 down to number 3, the third lowest poverty rate in the country. Again, what that's showing is the economic benefits are being felt widely throughout our state. The only states with lower poverty rates than Utah, New Hampshire and Hawaii. So think about it. You have to go way over to the East Coast or halfway across the Pacific to get a lower poverty rate than Utah. To put that in perspective, look at New Mexico, topping 19% poverty rate. So it just shows you how well the state is doing in a number of different measures over economic health. Home values. Because we've got very high population growth and which is driving high migration, we're seeing a lot of demand for homes. And one of the struggles that we have in our state is that even though construction is leading the state in job growth, they are not able to keep up with demand for new homes. And so that's driving those prices up. So this is, the blue is Utah home values, the green is US. And you can see we surpassed the nation right around 2006, 2007, topped off right around 250,000. And then we dropped down after the Great Recession at 200,000. Where are we now? Closing in on 350,000. not even close to the national average. Again, great if you own a home, not great if you're trying to buy your first home. And that's one of our biggest struggles in the state, is developing affordable housing. For those first-time home buyers, those low-income home buyers, we've got to be doing more to bring that promise of home ownership to people, to other groups that haven't seen it in the past. So kind of looking forward, what do we see happening in 2020? Job creation, we say neutral to negative. Why negative? Because the view is that we may be starting to tap out of that available labor. As we start to see that unemployment rate getting tighter and tighter, it may start to pull down. And we saw signs of that this morning, where the actual number of jobs created were lower than the expectation because of that tight labor market. Unemployment, neutral to positive, because we continue to see downward pressure, and we're at a 50-year low. Wage growth, we're kind of neutral. I might tweak that now from today's report, because it came in below our expectations and it continues to go down. Labor force participation rate in the intermediate term is looking really good. Consumer confidence is good. The consumer feels good. Overall economic growth, neutral, I'd say maybe slightly positive. Of course, we talked about weakness in the manufacturing sector. Housing prices, while they are much higher than they've been, if we look at the growth rate in home prices, it's starting to come back down again, so there may be a little bit of an opportunity there. Federal Reserve is watching this really close. I might pull that negative off and just say more neutral right now. And then inflation is coming in a little below, but pretty close to the Fed's overall goal. So overall, 2019 was a really interesting year. Hopefully 2020 won't be as interesting as 2019, but things are looking a lot better for our country and for our state. Thanks so much. So we've got about 10-15 minutes, and then if you've submitted questions, Drew, do you want to read those and I can
yeah,
answer
and then I think
those?
Natalie is going to be coming around checking to see if there are any last minute questions. So if anybody has any questions they'd like to add or anything like that, I'm certain we have a little bit of time to hopefully address those. But all right, first off, let's start with unemployment and wages. As unemployment is at historic lows and technology replaces humans in many sectors, do we expect the number of new jobs per month to decline? And does this mean that the economy is weakening?
Yeah, it's really interesting, and we are in, like I said, a technological revolution. I'll give you one example. Autonomous cars, self-driving cars, we're not quite there. They're not quite being fully implemented in our country, but I think we are really within about 10 to 20 years of them really being realized. So overall, that's going to be great. It's going to reduce deaths. It's going to increase efficiencies, but it's going to displace millions of workers. Think about the trucking sector alone. They say 1 million jobs will be displaced in the trucking sector alone because of self-driving technology. So there will be, overall, there will be negative impacts. Another one is Uber. Uber has already said that their ultimate goal is to have you driven by the car, not by a driver. And so that will displace a lot of jobs. However, and this is what we see with technological revolution, there are definitely areas where people suffer, and there are areas where there's pain. But overall, if we know about this early, and we work with people and we prepare them for this, I believe that our country can actually be better off, and I think our economy can be stronger. I wouldn't advocate that we try to not have technological advancements to try to protect those individual jobs, but we need to be ready now. We know that this is going to happen. We know that there's going to be these changes, and we need to be preparing people for it now.
All right. And kind of continuing to focus more on the wages and productivity issue. If wages are being held down, is that because of increased productivity, perhaps?
Yeah, that's another interesting one. I didn't include that, but we've been watching labor productivity quite a bit as well. One of the interesting trends is labor productivity has actually been declining for the past several years. And there was a long-term trend of that productivity coming down a little bit. Again, right around 18 months ago, that flipped. So, interestingly, it seems that there may be a direct relationship between that wage growth and that productivity. So we are going through, now it is still, I would argue, it's still a little too early to know for sure whether we're on a new trend line for productivity, but we're starting to see that productivity going up, and I think that would be an indication that, that what we're seeing in that technological revolution is being felt, and we're, employers and workers are becoming more able to more productively produce those goods and services.
All right. And now shifting a little bit more to some concerns people have about the future economy. So let's start off with the Fed. Obviously that's one of the kind of the geekier points we touched on in this presentation. But if the Fed drops the federal funds rate when they want to stimulate the economy, the Fed drops the federal funds rate when they want to stimulate the economy. In the last 3 downturns, they had to cut rates over 5%, with rates only at 1.5 to 1.75%. Does the Fed have the tools to stimulate the economy if it starts to weaken?
Great question. No. And that's what I'm scared about. It's true. The last 3 recessions, the Fed dropped the federal funds rate by 5% to fight the downturn. They don't have the tool right now that they've had in the past. So what do? Well, what they've done in Europe and what they've done in Asia is they've gone to negative interest rates. So the Fed has already been asked about this, and they've said we will not go negative. But if the economic situation gets hard enough, they may be forced to go to negative interest rates. The other thing the Fed has done is they increased what they call it their balance sheet. So the Fed literally buys assets. They buy mortgage-backed securities. They buy Treasury securities. And before the Great Recession, they had about $800 billion in their assets. They went up to $4.5 trillion in their balance sheet. And guess what? They tried to start about 2 years ago. They started selling it off. And what happened? The markets freaked out. If you remember, now I'm going to go really geeky, the repo market, the overnight repo market jumped from 2% to 10% back in September. That was a sign that the markets were freaking out about or reacting strongly to the Fed's action with their balance sheet. And what did they do? Jerome Powell came out and said, never mind, we're going to stop selling off our balance sheet and we're going to start putting it back up again. So the Fed can continue. They could, theoretically, they could take their balance sheet from 4.5 trillion to 8 trillion. But what is that balance sheet? It's debt. And so, again, the Fed doesn't have the tools that they've traditionally had. And it does make me nervous that our federal funds rate is so low and that the Fed's balance sheet is so high. And so I don't think they will be able to act as aggressively in the next recession as they were able to in last recessions unless they start resetting. Now that's a good thing because the economy is looking pretty good right now, and if it continues to move forward, there's an argument. We're in the longest economic expansion in our nation's history at just over 10 years. Australia has been growing for 20 years. So it's possible that we're only halfway through our economic cycle. If we are, and if we continue to see strength, I think the Fed needs to be getting rates back up to a level where they have that tool when the next recession hits.
All right, so the next question deals with something that people across the political spectrum have been really concerned about, especially in recent years, over the last 20 years especially. At what point should we be concerned about $1 trillion a year deficit and its impact on the economy?
Yeah, that's a really tough one. In absolute terms, right now, it's not providing a problem. However, I am concerned about it. Just like there are some people that say, well, you can't compare national debt to household debt because it's so much more complex. I think that's bunk. I think it is the same. Yes, it's more complex, but look at your household. Look at a business. Look at the state government. If debt gets too big, the cost of servicing that debt grows, and you have less disposable money to spend on important things. And we can only say we're different for so long until eventually we turn into Greece. And I don't know where that point is, but the higher our debt gets, the more problematic it becomes, and the more I get concerned about it. And so in the long term, like I said, I'm not worried about it right now in the short term, but in the longer term, it's becoming more of a problem and I'm getting more nervous about it.
And continuing to stick with rates across the government, is the yield curve still a relevant predictor of the economy?
Well, that's a really interesting question too, because I showed you the yield curve inverted last year, and historically, every time the yield curve, the 210 yield curve is inverted, a recession has resulted. So now it usually results in about 18 months. We're only 6 months out. So that's kind of the warning sign. That's in the back of my mind. I'm thinking that trigger still happened about 6 months ago. So either the yield curve is going to create that recession, but I'll tell you, most economists don't agree with it. So there's a chance. I mean, let's hope. Let's hope the yield curve indicator is broken. Otherwise, we have a recession on the way. But yeah, it will be really interesting if this presents the first time in probably over 50 years that an inverted yield curve does not turn into a recession.
All right, now that we've gotten the fearful section out of the way, let's go a little bit more positive. Why is the healthcare sector doing so well, especially in Utah?
So this is part of a long-term trend, and this really is a very positive story. If you look at the standard of living of individuals living today, it is so much higher today than it was 100 years ago. And what have we decided, what have we as a society decided that we value? We value our health. And so we as a society are demanding higher health services. Just think about when you go to the doctor today. You feel a pain in your shoulder, and what do? You walk in and you want the MRI. 100 years ago, they would have, maybe, did bloodletting or something like that. Maybe that's 200 years ago. I was watching a show about Robin Hood, and they say that's how Robin Hood died, because they bloodletted him too much. But we have these amazing services, and they're created because we as a society want to shift our spending there. In America specifically, we have the highest portion of our economy is going towards healthcare. I don't think that's a bad thing. I think it's resulting in very positive healthcare outcomes. Just this morning, I read an article in the Wall Street Journal that said they're predicting that there is a person born today who will live to be 200 years old. Just think about that. It's crazy. But it's because of these revolutions. They were talking about it in the context of you better be careful about your retirement planning, because you're not going to retire. You better not plan on retiring for 100 years. But that's the other side of it, of course, though, right? These are all great things. We're living longer. We're doing better financially. Our standard of living is higher. But then the other side of it is, we need to start changing our expectations of our working life. That's a great example. My grandkids will not be retiring at 62. They might be retiring at 162. And so, but we even now need to start adjusting our expectations of how we're going to live and how we're going to die.
All right. Now, this is a topic that our department has had a little bit of experience with. So what's going to happen with cryptocurrencies in 2020, Robert?
Oh, cryptocurrencies. Yeah, we actually had, I think it was about a year ago, we had a special lunch session on Bitcoin and cryptocurrencies. And what's really interesting, if you've ever heard of the Danish tulip mania, compare the price of tulips in Denmark 200 years ago to the price of Bitcoin 2 years ago. And you see very similar trends. You see those prices getting run way up and then crashing way back down. Now, having said that, are tulips today worthless? No, they're not. And there are some tulips that are very, very valuable. But it was the drive up. What we saw was a huge drive up in cryptocurrency. I believe Bitcoin alone, one Bitcoin was worth over 20,000. And now they're worth about 7,000?
I think they're actually back up to 8,000.
Okay,
So,
7 to 8,000. So they're not worthless, but they're not. But they're worth about a third of what they were a couple years ago. Now, when you look at the technology, crypto currency, that really is part of that technological revolution that we've been talking about. It will change the way that we interact. It will change the way that you buy a car or buy a house. And that blockchain technology really is going to be revolutionary. But it is an interesting case study in kind of that mania and how it can drive expectations.
this is a little bit more of a personal question for myself here. What do you think is going to be if you had to pick one, what is going to be the biggest story you think of 2020 in terms of economics? If you had to pick one.
Well, it's going to be the one big trending issue, in my opinion, is going to be international relations. Whether looking at the trade war. Now, they're supposed to be signing a phase 1 trade agreement next week. I hope it happens. But then you also have USMCA. You have the Iranian potential war. And overseas, you have Brexit. And all those is creating this uncertainty. It's the reason that businesses are nervous. It's the reason that some international economies are already contracting. And so I think that theme is going to be the overarching theme of 2020. If we can resolve these, if we can find a good trade deal with the Chinese, if we can resolve USMCA, if we can defray the problems if Iran, if we can figure out Brexit, then I think our economy has some very high upside potential. But if any of those go the other way, we could be in big trouble.
All right. I think that'll conclude today's Outlook. Thanks so much for coming, everyone. And we hope you have a great Friday.